हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है जॉइंट अरेंजमेंट, दैट इज इंडियन अकाउंटिंग स्टैंडर्ड ट्रिपल 1 पार्ट 2। इन द previous discussion we had discussed scope and objective of these standard. Then we had discussed about the what is joint arrangement. We had discussed in detail about the joint arrangement, about the joint control along with various illustrations. In today's discussion we are discussing about the types of joint arrangement and also about the accounting treatment in case of joint along with various illustrations related to RTP questions. Now, types of joint arrangement. Types of joint arrangement is joint operation and joint venture. There are two types of arrangement, that is joint operation and joint venture. What is joint operation? If two or parties are there or more than two parties are there, they entered into an agreement, a written or oral, whatever the form may be, does not create a separate legal entity. It is a joint operation. Means if separate legal entity means whose all the constitutional rights are separate, so that is a separate legal entity. If it does not form a separate legal entity, then it's a joint operation. All the assets, liabilities, income and expenses is related to the parties who create that joint operation. All the output which comes out from that operation is consumed by that party who create that operation. And if two or more parties entered into an agreement to create a separate legal entity, then it's a joint venture. If it does not create a separate legal entity, it's joint operation. If it creates a separate legal entity, then it's a joint venture. Example for joint operation is firm. Partnership firm is a joint operation because the income which arises, it should be shared between the partners. The liability is to be shared between the partners. But in case of joint venture, in form a separate legal entity, in form of company, in form of LLP, after paying all the liabilities, after paying off all the expenses, whatever left out income is distributed in the form of dividend to the shareholders. The net assets or net income is to be given to the shareholders. If the first step, that is the legal form, is not satisfied, though it was a joint venture, still it becomes joint operation if not fulfill the second criteria and third criteria. The second criteria means if the parties enter into a contractual agreement, in that agreement it is mentioned that parties can get the share in the assets, liabilities, income and expenses, then it's a joint operation. Though it becomes a separate legal entity, but it is if it is mentioned in the contract that the parties who enter into a contract will be sharing the assets, liabilities, income and expenses, then it comes under the purview of joint operation. If the contractual arrangement is silent about the income and expenses sharing criteria, then you have to check the third condition, that is the other facts and circumstances. In that case, what happens? Whatever the output comes out, if it is consumed by the operator only, the parties who created the arrangement, and at a break-even point, that is at cost without profit, then it is a case of joint operation. But if it is consumed by third party other than the person who has created that arrangement, not at a break-even, at a profit, then it is a case of joint venture. Second condition, that is the contractual arrangement is silent about the sharing of the assets, liabilities, income and expenses, then you have to check the third condition, whether whatever the output comes out, the operation in the arrangement is consumed by the parties who created the operation, who created the arrangement, or it is consumed by the third party. If it is consumed by the third party, it is a case of joint venture, and if it is consumed by the person who has created that arrangement at a break even, then it is a case of joint operation. Now, joint operation is explained with the help of examples. Suppose P Limited and Q Limited are two construction entities and they have entered into a contractual arrangements to jointly construct a metro rail project. The construction of metro rail project involve various activities such as construction of infrastructure like metro station, control room, pillars at the center of the roads, etc. for the metros, laying of tracks, acquiring of the coaches of the metros, etc. The total length of the metro line is to be constructed is 50 kilometers. As per the agreement, both the parties are responsible to construct 25 kilometers each. Each party is required to incur its own cost, use its own assets, incur the liabilities, and has the rights to revenue from their own parts of the work. Determine whether the joint arrangement is a joint operation or not. The arrangement is a joint joint operation. Firstly, it is not structured through a separate vehicle because P and Q Limited are two construction entities and they have entered into contractual arrangement and they are not created a separate legal entity, separate vehicle. If they had created a separate vehicle, then it's a case of joint venture. But they had not created a separate vehicle. They are joined hands to construct a rail project in order to work on a project, and the assets, liabilities, income and expenses borne by each of the party individually. So it's a case of joint control. Each party has the rights to the assets, obligation for the liabilities relating to their own part of the work in the joint arrangement. So it's a joint operation. Joint operation by sharing an assets. Suppose RS Limited and MN Limited entered into contractual arrangements to run a business of providing cars of hires. The cars will be owned by both the parties jointly. The expenses to run the car like driver salary, petrol, maintenance and insurance, etc., and the revenues from business will be shared between both the parties as agreed in the contractual arrangement. Determine whether the arrangement is a joint operation or not. In this case, what happened? RS Limited and MN Limited entered into a contractual arrangements to run a business of providing cars of hire. So they does not created a separate legal entity in order to run the business. Firstly, they had made only a contractual arrangement to run a business of providing cars. The car will be owned by both the parties jointly. So unanimous consent is required. So whatever the expenses and revenues are there, it should be mentioned in the contract that share is given to the RS Limited and what was the share of MN Limited. So it's a joint operation since the arrangement is not structured through a separate vehicle. If it is structured through a separate vehicle, then it's a joint venture. The legal form indicates that the arrangements to be a joint venture. In this case, we have three conditions we have discussed, that is the legal form, then contractual arrangements, then other facts and circumstances. If legal form is there, then it's a case of joint operation or joint venture as per the legal form. If separate legal entity is formed, then it's a case of joint venture. If separate legal entity is not formed, it's a case of joint operation. Suppose entity X and entity Y are engaging in the business of engineering, procurement and construction for its customers. Both the parties have jointly owned a contract from a customer for executing an EPC contract, and for that the parties have established a new entity XY Limited. The contract will be executed through XY Limited. Now another condition we have to check, all the assets required for execution of contracts will be acquired and liabilities relating to the execution will be incurred by XY Limited in its own name. So all the assets are handled by XY Limited and all the liabilities are handled by XY Limited. It is handled by the separate legal entity itself. Entity X and entity Y will have share in the net profits of XY Limited in the ratio of their shareholding, that is 50% each. Assuming that the arrangement meets the definition of joint arrangement, yeah, it's meet the definition because it's a contractual arrangement. Unanimous consent is required because both the parties is having the voting rights of 50%. The arrangement is a joint arrangement, but it's not a joint operation, it's a joint venture. So determine whether the joint arrangement is a joint operation or joint venture. The legal form of separate vehicle is a company. The legal form of separate vehicle causes the separate vehicle to be considered in its own rights. Hence it indicates that the arrangement is a joint venture. If other facts and circumstances is to be checked, whether the output is consumed by the parties itself or by the third party. In this case, the party should further evaluate the terms of the contractual arrangements and other relevant facts and circumstances to conclude whether the arrangement is a joint venture or joint operation. With the evidences available, it's a case of joint venture. Now assessing the terms of the contractual arrangements. Continuing with the illustration 16, that is we had mentioned whatever in the previous example, assuming that entity X and entity Y have entered into a separate agreement whereby they had agreed that each party has an interest in the assets of XY Limited and each party is liable for the liability in the XY Limited in a specified proportion. Determine whether the joint arrangement is a joint operation or joint venture. The entity X and entity Y entered entered into a separate agreement whereby they had agreed that each party has an interest in the assets of XY Limited and each party is liable for the liability of XY Limited in their specified proportion. That so whether the arrangement is a joint operation or joint venture. In this case, the terms of the separate agreement may cause the arrangements to be a joint operation because they have a proportion in the assets and proportion in the liabilities. Though it's a case of joint venture, still the other facts indicate that they have interest in the assets and liabilities of the separate legal vehicle. So it's a case of joint operation. Legal form indicates that the arrangements to be a joint operation. Two entities have established a partnership firm with each party having 50% shares in the net profits of the firm. Assuming that the arrangement meets the definition of joint arrangements, determine whether the joint arrangement is a joint operation or joint venture. In this case, the parties to the arrangement should evaluate whether the legal form creates separation between the partners and the partnership firm. If the parties conclude that they have the rights in the assets and obligation from the liabilities relating to the partnership firm, then this should be a joint operation. If the assessment of the legal form is a partnership firm indicate that the firm is a joint operation, then there is no need to evaluate any other factors and its need conclude that the partnership firm is a joint operation. So it is said that partnership firm itself is a joint operation because all the assets and liabilities are related to the partner only. The parties agree to purchase all the output produced by entity A in the ratio of 50:50. Entity A cannot sell any of the outputs to the third parties unless this is approved by the two parties to the arrangement. Because the purpose of the arrangement is to provide the parties with output they require, such sales to third parties are expected to be uncommon and not material. The price of the output sold to the parties is set by both the parties at the level that is designed to cover the cost of the production and administrative expenses incurred by entity A. On the basis of the operating model, the arrangement is intended to operate at a break-even level. Based on the above platform, determine whether the arrangement is a joint operation or joint venture. Solution: the legal form of entity A and the terms of the contractual arrangement indicate that the arrangement is a joint venture. As we have discussed, with the legal form, because separate vehicle is to be incorporated, and as per the contractual agreement, it indicates that the arrangement is a joint venture. However, if we look into the other facts and circumstances, it overrides the condition 1 and condition 2. It overrides the legal form and it also overrides the contractual arrangements. It indicates that the obligation of the parties to purchase all the output produced by entity A reflects the exclusive dependence of the entity A upon the parties for the generation of cash flows, and thus the parties have the obligation to fund the settlement of the liabilities of entity A. The fact that the parties have right to all the output produced by entity A means that the parties are consuming and therefore have the rights to all the economic benefits of the assets of entity. So it itself indicates that all the income which is generated by entity A is consumed by parties who had incorporated entity A. So these facts and circumstances indicate that the arrangement is a joint operation. The conclusion above about the classification of joint arrangement is these circumstances would not change if instead of parties using the share of the outputs themselves in a subsequent manufacturing process, the parties sold their shares of outputs to the third party. If the parties change the term of the contractual arrangement so that the arrangement was able to sell the output to the third party, this would result in an entity A assuming demand, inventories and credit risk. In that scenario, such a change in the facts and circumstances would require reassessment of the classification of joint arrangement. Such facts and circumstances would indicate that the arrangement is a joint venture. If they change in the contractual arrangement that the output is consumed by the third party also, then it's a case of joint venture. But as per the other facts and circumstances, it's a case of joint operation. Now, multiple joint arrangements with single frameworks agreements. Suppose AB Limited and CD Limited have entered into a framework agreements to manufacture and distribute a new product, that is product X. The two activities to be performed as per the framework agreements are manufacture of product X and the distribution of product X. The manufacturing of the product will not be done through a separate vehicle. The parties will purchase the necessary machineries in their joint name same, for the distribution of the product, the parties have established a new entity ABCD Limited. All the goods manufactured will be sold to ABC Limited as per the price manually agreed by the party. ABC Limited will do the marketing and distribution of the products. Both the parties will have a joint control over ABCD Limited. So the legal form of ABC Limited cause it's to be considered in its own right, that is the assets and liabilities held in the ABC Limited are the assets and liabilities of ABC Limited and not the asset and liabilities of the party. Further, the contractual arrangements and other relevant facts and circumstances also indicate otherwise. Determine whether the arrangements is a joint operation or joint venture. The manufacturing of the product will not be done through separate vehicles. The manufacturing is not done by the distribution part is done by the separate vehicles. All the goods manufactured will be sold to the ABCD Limited as per the price manually agreed by the party. Both the parties having a joint control over the ABC Limited. Solution: the manufacturing of product X is not done through separate vehicle and the assets used to manufacture the product are jointly owned by the party. In manufacturing activity is a joint operation, but the distribution of product X is done through separate vehicle, that is ABCD Limited. They created as ABCD Limited in order to do the marketing and distribution. So distribution is product is done through a separate vehicle, that is ABCD Limited. Further, AB Limited and CD Limited do not have rights to the assets and liabilities relating to the ABCD Limited. Hence, ABCD Limited is a joint venture. So ABCD Limited, that is the distribution part, is a joint venture, but the manufacturing part is done by AB and CD Limited and having joint control on that manufacturing of product X, and that asset is used to produce because it does not create a separate vehicle and jointly owned by both the parties. So manufacturing activity is a joint operation. Ind AS clarifies about the accounting in the books of the parties, that is the joint operator or joint venturer. How accounting is to be done? In case of joint operation, if the party is having a joint control, if three parties are there, suppose in our example which we had discussed, A is having 50% stake, B is having 30% and C is having a 20% stake, and it's create a joint arrangement because unanimous consent is required and contractual arrangement is there. If A and B join hands, C's consent is not required in order to take the decision on relevant activities. So A and B is having a joint control, but C does not have a joint control. So in that case, what happen in case of joint operation? If A and B having a joint control, in case of separate financial statement, Ind AS 111, that is proportionate method is applied, that is assets of A plus share of assets in the joint operation as liability of A plus share of liability in the joint operation. If the parties does not have joint control, but it is a case of joint operation, that is in case of C will also prepare his individual balance sheet and also the share of his assets in the joint operation, that is 20%, the share of liability, share of income, and though he doesn't have a joint control, but still they prepare their balance sheet as per Ind AS 111, that is on proportionate method. And CFS also prepared on a proportionate method by A, B and C. Separate financial statement is also prepared by A and B and C in case of joint operation. But if it is a case of joint venture, it comes under the purview of Ind AS 27 and Ind AS 28. If they have a parties to have a joint control in case of joint venture and they have a controlling stake, like they have a subsidiary, they have associates, or they have a joint venture, in case of separate financial statement, they follow Ind AS 27, and in case of consolidation, accounting is to be done as per Ind AS 28, that is equity method. They have a significant influence, that is accounting in case of separate financial statement, that they follow Ind AS 27, and if they does not have significant influence, they follow as an investor, they will follow financial instrument, that is as per Ind AS 109. Now in case of consolidation, in case of joint venture, if the parties is having a significant influence, then they follow they prepare consolidation as per Ind AS 28. If they do not have significant influence, CFS is not applicable for the investors. Now accounting of interest in the joint arrangement. Now we will discuss some of the illustration related to the accounting part in the joint arrangement, that is joint operation ka accounting we will do as per Ind AS 111. So P and Q form a joint arrangements PQ using a separate vehicle. P and Q each own 50% of the capital of PQ. However, the contractual terms of the joint arrangement states that P has the right to all the machineries and obligations to pay bank loan in P. P and Q have the rights to all the other assets in PQ, an obligation for all other liabilities in PQ in the proportion to their share of capital, that is 50% each. PQ balance sheet is as follows. Balance sheet, that is the liability, capital is 1,50,000, bank loan is 75,000, other loan is 75,000. In asset size, machinery is 2,50,000, cash is 50,000, and total becomes 3 lakh. How should P records in its financial statement its rights and obligation in P? This is the balance sheet of PQ Limited, that is a joint separate vehicle is to be created by P and Q, two parties in the joint arrangement, and having 50% share of interest, the PQ Limited, which they had created. Now, accounting of interest in joint operation. AB Limited and BC Limited establish a joint arrangement through a separate vehicle, PQR, but the legal form of separate vehicle does not confer separations between the parties and the separate vehicle itself. Thus, both the parties have the rights to assets and obligation for the liabilities of PQR, as neither the contractual terms nor the other facts and circumstances indicates otherwise. It is concluded that the arrangement is a joint operation and not a joint venture. Both the parties own 50% each of the equity interest in PQR. However, the contractual terms of the joint arrangement states that AB Limited has the right to all the building number 1 owned by PQR and obligation to pay all the debts owned by the PQR to the lender XYZ. AB Limited and BC Limited have the rights to all other assets in PQR and obligation for all other liabilities in proportion of their equity interest, that is 50% each. This is the balance sheet of PQR Limited which they created. Both the parties created, that is AB Limited and BC Limited, had created a separate vehicle PQR. That is the legal form. In the contractual agreement, they had mentioned that the AB will take this percentage of PQR and BC will take this percentage of PQR. They had mentioned that they have interest in the assets and liabilities, income and expenses of the operation. So it's a case of operation. Now, what was the interest? We have to determine the interest of AB to account for its right in the assets of PQR and obligation for liability. So AB under Ind AS 111, AB should record the following in the financial statement to account for its right in the assets of PQR and its obligation for the liabilities in PQR. In debt owned by, he will take full 240. Employees benefit he will take because it is given in the question 100. He will take 50%. Equity it is given in the question 140, so he will take 70. And in asset size, building 1 is fully given to the AB Limited, so 240 is fully considered by AB. In building 2, 200 is there. He will take the half 50%, so 100 is considered. Cash is 40. He will consider his own share, that is 20. So in this way, the consolidation is done, that is proportionate consolidation in the books of AB. Now, accounting for sales or contribution of assets to a joint operation. Now, how accounting is to be done for sales or contribution of assets to a joint operation? A Limited is one of the parties to a joint operation, holding 60% interest in the joint operation and balance 40% interest is held by another joint operator. A Limited has contributed an asset held by it to the joint operation for the activities to be conducted in the joint operation. The carrying value of assets sold was rupees 100 and the asset was actually sold for rupees 80, that is at a loss of rupees 20. How should A Limited account for the sale of assets to joint operation in its books? So it is said A Limited is holding 60% interest in joint operation and the balance 40% is held by another joint operator. Now, A Limited contributed an asset held by it. A Limited sell it asset to the joint operation. Joint operation को उसने A Limited ने, जिसमें वो 60% stake है उसका ही है. The carrying value of the asset sold was, जो उसके बुक्स में था A Limited के बुक्स में, अब वो joint operation को दे दिया उसने at a sell price of 80. तो उसने कितना लॉस बियर किया? 20 लॉस बियर किया. A Limited का एसेट है, A Limited की कंपनी को ही जा रहा है जिसमें वो 60% स्टेक ऑलरेडी होल्ड कर रखा है. तो उसने एक्चुअल में सेल कितना किया? 40%. जो अदर ऑपरेटर्स जो होल्ड कर रहे हैं उन्हीं को सेल, अपने आप को सेल नहीं किया. सो A Limited should record the loss on the transaction only to the extent of other parties' interest in the joint operation. The total loss on the transaction is 20 lakh. Hence, A Limited should record the loss on the sale of asset to the extent of rupees 8. 20 into 40%, that is rupees 8, which is in loss pertaining to the interest of the other parties to the joint operation. जो other parties का interest है joint operation, उतना ही वो सेल किया, उतना ही वो लॉस अपने बुक्स में दिखाएगा. The loss of 12 shall not be recognized as this, that is the unrealized loss. Further, while accounting its interest in the joint operation, A Limited shall record its shares in the assets at the value of rupees 60. The asset was actually sold for 80. So 80 का 80% तो उसी का शेयर हो गया ना. 80 into 40% वो इतना रिकॉर्ड करेगा इन इट्स बुक्स. So journal entry for the transaction would be bank account debit by 32, loss on sale is 8, that is to asset 40. So he will record only to the extent which they are sold to the other parties. So bank account जो भी उसी into 40% that is 32, loss उसको हुआ है on sale because the carrying value of the asset will be 100. जो 100 का माल उसने 80 में सोल्ड किया तो लॉस ऑन सेल रिकॉर्ड करेगा टू द एक्सटेंट अदर पार्टीज को जो सेल कर रहा है दैट इज 40% ऑफ 20. सो इट विल बी 8 एंड एसेट जो भी है वो 100 का 40% ही रिकॉर्ड करेगा. और अकाउंटिंग फॉर परचेज ऑफ एसेट्स फ्रॉम जॉइंट ऑपरेशन, अगर ए लिमिटेड है जो कि पार्टी है इन द जॉइंट ऑपरेशन, वो अगर होल्डिंग 60% इन द ऑपरेशन एंड बैलेंस 40% इंटरेस्ट इज टेकन बाय अनदर ऑपरेटर, एंड इफ ए लिमिटेड परचेज सम एसेट्स फ्रॉम जॉइंट ऑपरेशन, अगर ए लिमिटेड जॉइंट ऑपरेशन से कुछ परचेज करता है जिसका कैरिंग वैल्यू 100 है और जो एक्चुअली उसने परचेज किया 80 में एट अ लॉस ऑफ 20, सेल के टाइम आप लॉस रिकॉर्ड करोगे बट एट द टाइम ऑफ परचेज you will not record any loss in your books. How much you will record? The purchase price 50% जो other party का interest है वही purchase किया, तो 80 into 40 that is 32. Asset account debit to bank. So A Limited should record its share of loss until the asset is resold to the third party. A joint operation has sold the assets of at rupees 80 by incurring a loss of 20. Hence A Limited shall record at least the asset at 92, that is the purchase price rupees 80, and A Limited share in the loss that is 12. Further, while accounting in the interest in the joint operation, A Limited shall not record any share in the loss incurred in the sale transaction by the joint operation. So A Limited क्या जो भी asset purchase किया उसका जो share है 80 का 40% that is 32 to bank. Now another illustration. On 1st April 2021, Alpha Limited commenced joint construction of a property with Gamma Limited. For this purpose, an agreement has been entered into that provides for joint operation and ownership of the property. All the ongoing expenditure comprising maintenance plus borrowing cost is to be shared equally. The construction was completed on 30th September 2021 and the utilization of property started on 1st January 2020, at which the time estimated useful life of the same was estimated to be 20 years. Total cost of construction of the property was rupees 40 crores. Beside internal accruals, the cost was partly funded by way of loan of rupees 10 crores taken on 1st January 2021. The loan carries at an annual rate of 10% with interest payable at the end of the year 31st December 20 each year. The company has spent rupees 4 lakh on the maintenance of such property. The company has recorded the entire amount paid on the investment in joint venture in the books of accounts. Suggest the suitable treatment of the above transaction as per applicable Ind AS. So solution as provided in Ind AS 111. Joint arrangement, two or more parties having joint control of the property under a contractual arrangements. The arrangement will be regarded as a joint operation because Alpha Limited and Gamma Limited have the rights to the assets and obligation for the liabilities of the joint arrangement. So it's a joint arrangement. 111 accounting is to be done as per Ind AS 111 because it's a joint operation. In the contractual arrangement, it was mentioned that both the parties have the right in the assets and liabilities. This means that the company and other investors will recognize 50% of the cost of the constructing the assets in the property, plant and equipment. So accounting will be done in a proportionate consolidation. The borrowing cost incurred on the construction should under the principles of Ind AS 23, that is borrowing cost, to be included as a part of cost of the assets for the period of construction. Means before the commencement of the business, whatever borrowing cost is to be incurred is to be accounted for as per Ind AS 23, which is to be capitalized with the assets. So in this case, the construction was completed on 30th September 2021. Though the construction was completed on 30th September 2021, the cost which was incurred up to the date of construction, the cost is to be capitalized. That is, the total cost of construction of the property is 40 crores and the borrowing cost is, the loan carries an interest at the rate 10%, is to be capitalized as per Ind AS 23. So the property, plant and equipment, the total cost up to 30th September 2021 is 40 crores. 6 months interest borrowing borrowing cost is to be capitalized before the commencement of the operation, that is 10 crores into 10% for 6 months. WDV after giving the interest impacts, that is on 30th September 2021, 40.5 crores will be the cost. Now 6 months depreciation is to be charged over the useful life of 20 years. 40.5 into 6 divided by 12, so it becomes 1.0125 crores. Now WDV as on 31st March 2020 after considering the interest and depreciation become 39.4875 crores. What amount should be recognized in the books of Alpha and Gamma on a proportionate basis? So amount to be recognized in the books of Alpha and Gamma Limited on a proportionate basis, depreciation is to be charged in the ratio, that is 50-50. So it becomes 50,62,500 for each Alpha and Gamma, and interest cost for remaining 6 months, which is to be recognized in profit and loss account, 25 lakhs and 25 lakhs. And maintenance cost is also given in the question, that is 4 lakhs, which are distributed between Alpha and Gamma, that is 50-50%, that is 2 lakhs and 2 lakhs, and they will recognize in their profit and loss account. So in this way the accounting is to be done on a proportionate basis because it's a joint operation. The entity has made accounting as per joint venture, which is incorrect. Thanking you for watching my video. If you like, please share, subscribe me.